Hello, everyone, and welcome to the webinar Beyond the Bubble and AI, Finding Real Opportunities for Energy Investment. My name is Chris Robinson, Senior Director here at Lux Research, and I'll be moderating today's session. Presenting today is my colleague Anthony Schiavo, Senior Director and Principal Analyst here at Lux Research. Throughout the webinar, you can type any questions you have into the questions box on your screen. Time permitting, we'll get to all the questions that we can. If your question doesn't get answered, please don't hesitate to email it to questions@luxresearchinc.com, and we'll make sure to respond. And lastly, if at any point you experience any technical difficulties, like a frozen screen, simply refresh your browser and check that your internet connection is strong. Now let's jump into the presentation. Over to you, Anthony.
Thanks, Chris, and thanks everyone for joining me today. In this talk, we're gonna first dig deep into what's possible for AI demand. It's one of the biggest questions we're getting asked about, and there's a huge amount of hype and excitement around the seemingly explosive growth of AI. But what does that really mean for data centers and for energy? Then, throughout the talk, we're going to explore a framework that you can use to prioritize AI deployments in your own business. And we can leverage that to understand the trajectory of AI in the corporate space and the broader economy. And then we're going to take a step back and get a little philosophical. And we're going to look at AI as a technology of seeing. But to do all that, we're going to have to all become time travelers. So I encourage you to come with me on a time traveling journey. We're going to start here in 2025. We're going to look at the AI boom and the potential AI bust. Then we're going to go back to 1999, look at a previous bubble and crash, and learn some lessons there. And then we're going to go all the way back to 1765, to the invention of the technology of seeing, and see what lessons can be gained from something that's over 300 years in the past. So with that, let's begin. Are we in an AI boom or an AI bust? Well, we know that AI companies are worth a lot of money. OpenAI just raised $40 billion at a $300 billion valuation. There's some uncertainty around that as they just announced changes to their corporate structure. But it's very much a leader in the space. But it's not alone, right? Musk's xAI is at some $75 billion valuation. Anthropic is at a $61 billion valuation. And there's a number of other $10 billion startups in the space. So these startups are worth a lot of money. And in order to sustain those valuations, they will need a lot of revenue. So if we take the $300 billion OpenAI valuation as an example, and we apply Google's revenue to value multiple, which I think is fair, then you get a revenue target of around $42 billion. A lot of companies, a lot of people think that OpenAI is the next Google. It's a pretty fair comparison. And it's also worth noting that this is less than OpenAI's stated revenue target. It's about half. They're targeting about $100 billion of revenue by 2029. So extremely aggressive growth. I mean, unprecedentedly aggressive growth. So these companies need to raise a lot of revenue. And I think it's a fair question to ask, is this $42 billion revenue target really achievable? And for that, we can look to DeepSeek. DeepSeek, if you somehow missed it, is the Chinese AI company. They launched a new model, R1, a couple months ago, that really shook the AI world and the tech world. It had people like Mark Andreessen, speaking in Cold War terms, right? And the reason why it shocked the world was because it was so cheap. It matched the performance of Western models at a fraction of the cost. But DeepSeek is an open source company. They're very, very committed to open source. They're so committed, in fact, that they actually open sourced some data around their operating expenditures and revenues. And we can use that to get a sense of what OpenAI needs to do. We can make some projections about OpenAI's revenue based on the data that DeepSeek has given us. So DeepSeek, they claim to have a daily AI usage of about 608 billion tokens in and 168 billion tokens out. And a token here is just a fraction of a word. Don't worry too much about it. It's not that big of a deal. you can substitute word here and be pretty close. This usage level gave them a data center operating cost per day of around $87,000. They're renting out GPUs and GPU time at about $2 per GPU per hour. They claim that if they charged full price for these AI services, they would generate about $500,000 in revenue. But even they recognize that that number is not very realistic. There's a ton of discounting. A lot of services are offered for free. The services are cheaper at night. There's a bunch of different things. A more realistic estimate, if we just apply Google's sort of net profitability, would be around $153,000 per day. So if we scale that up to a year, we can see that this would be about 61 trillion tokens out, about $31 million in annual operating data center operating costs, and about 53 million in annual revenue. So that's a nice little small business, right? $53 million on $31 million of costs. Of course, DeepSeek is not just a data center operating company. They are developing AIs, and they're probably spending about $500 million a year on AI development in talent and in data center costs. But it's worth noting that, running this AI model is theoretically a profitable exercise. But of course, $51 million is not nearly as much money as we need. We need $42 billion a year. So using DeepSeek's numbers, we can scale up the costs and the usage, and we can get a sense of what kind of volumes OpenAI would need. At $42 billion of annual revenues, they would incur, operating costs of around $25 billion. And this would require an annual AI usage of 177 quadrillion tokens in and 48 quadrillion tokens out. And I want to pause here because 48 quadrillion is a really, really big number. It's actually so insanely big, you can't even really imagine it. To give you a sense, if you applied 150 or so tokens to every Google search that's done every day of the year, and Google does about 8.5 billion searches a day, 365 days a year, 150 tokens, that altogether would be about 1% of this 48 quadrillion number. A few years ago, GitHub took its entire code base repository, put it on very, very stable storage, and stuck it in the Seed Vault in Norway, deep underground, as a kind of preservation project. That entire code base, all those lines of codes together, is about 0.05% of this 48 quadrillion number. If you need something that's at that same scale, what we're really talking about is every spoken word from every person on earth, every human being, for an entire year. That gets you to about 105% to 110% of this 48 quadrillion tokens number. It is an insanely large number. And I can tell you, there's a lot of good applications for AI. This is our AI application selection framework. We're going to get into it a little later on in the presentation. But I spent the last 6 months doing a lot of work looking at different applications for AI. And I can tell you, there's some great ones. But the teams that are using AI in corporations right now are 20 people, 30 people, 40 people, right? There's simply not enough people to actually consume this much information, this much written text. Again, to get to this $42 billion revenue number, that's about 4.5 million words per person per year. That's about 90 books per person. Every single time a stoplight in America switched from red to green, you could write a 250,000 word book, epic length novel, every time a light switched in America. And you would just about consume this volume of information. I'm giving you all these examples because I want you to know, I want you to understand, this is not a human scale problem. The usage of AI by people cannot absorb the necessary volume to create the revenues that OpenAI needs. So if they want to achieve this $42 billion revenue target, they are going to have to do something else. They have a couple of alternatives. It's not impossible. One is raise prices. This seems really, really hard to me. The prices are falling, and they're falling pretty dramatically, right? DeepSeek is a fraction of the cost of OpenAI's advanced models. There's now other Chinese AI providers. I think Baidu came out with a couple models that are even cheaper than DeepSeek's now. So raising prices in an era of extreme price competition seems really challenging. Secondly, you can develop some kind of machine-to-machine application. And I think that that is possible, for sure. Something where you're having either the AIs talk to each other a lot, or more realistically, you're processing the same information multiple times. Maybe you are, processing video into text and audio, transcribing it, and you're then editing those transcriptions, or you're reading those transcriptions, and you're analyzing those transcriptions. I think you can drive the volume here. But again, we have a really long way to go. And the largest scale applications that we've yet come up with as humans are not are not sufficient to absorb this much information, right? So it's still really challenging. And lastly is become a consumer subscription company, right? And that's what OpenAI really, I think, is closest to doing. If you charge 100 million people $500 a month, you can get, or excuse me, $500 a year. You can get this type of revenue that you need. But that's really challenging as well, because you need 100 million paying subscribers. OpenAI has a lot of users, but they don't have nearly as many paying users. And they're also still losing a huge amount of money on those paying users. So big challenge here. I think what I'm pointing to here is that we're really at the peak of an LLM boom, and an LLM bust is up next. There's simply not enough revenue out there, and certainly not enough revenue from the corporate world to sustain all of these companies. So when the revenue dries up, the valuations will be hard to maintain, and things will start to spiral from there. And that brings us to the first of our history lessons. AI companies were overvalued in 2025. But knowing that, what can we do about it? Well, it's time to go back, all the way back to 1999, right? This is the next step on our time traveling journey. In 1999, this is the most advanced form of computing. This is the coolest individual around. And this is the major tech issue that we're all worried about. But something else was happening in 1999. And that was the dot-com bubble and the telecom crash. So if you look at the NASDAQ, you can see this bubble and crash very clearly here, right? I think what's interesting is it happened so quickly, right? 1998, you have Pets.com founded. By 2000, they have this very silly Super Bowl ad that they're running. And then by also 2000, just a few months later, they're out of business, liquidation, right? But what's important is that, when you think about a company like Pets.com, their business model wasn't wrong, right? The idea of, hey, we should sell pet supplies online on the internet. That's correct. We do that, right? We have Chewy.com. I have boxes upstairs from them. So the idea was totally correct. It's just that the hype and the bubble caused them to expand way too quickly and lose way too much money. So if we apply this type of thinking to AI, what we want to do as energy companies, right, or as outside observers, is we want to get value out of the growing demand for AI, and we want to avoid the risk of getting caught in the AI crash, right? We think AI is the real deal for the long term, just like Pets.com, internet e-commerce is very much the real deal. So we want to align to that, but we don't want to lose our lose all our clothes with the crash, right? So we have two options, I think. One is to pick the winner, right? If you invested in Amazon back in the day, then you would have been very, very successful now and very, very wealthy. But this is really difficult to do. It's really scary. Amazon almost went bankrupt. I think their stock was down 96%, almost to nothing, before they rebounded and became the company we all know today. And it's also really, really easy to pick a loser, right? Yahoo looked really good, or America Online. I mean, they were the companies that brought America the internet, but they were not the winners ultimately from the internet revolution. So, we want to avoid investing in today's Yahoo. That could very well be OpenAI. Instead, it's better to take a kind of picks and shovels strategy, right? Build businesses focused on selling the infrastructure, selling the necessary requirements, things that are going to grow alongside the growing demand for AI, but are not necessarily tied one-to-one with AI demand. And frankly, things that are a bit more in our wheelhouse as companies who are kind of on the outside of the AI bubble looking in. So strategy one for energy players is just to build power and build storage, put energy on the grid. And an example of a company that's doing this is Total Energies, right? They are developing a couple different solar sites in America. They already have a significant investment in solar power. But to complement this power, you really need storage. Storage is becoming a lot more common, especially in Texas. Jupiter Power just launched a major battery storage facility in Houston. And so with this, you can increase the ability of these data center companies to draw off the grid, increase the reliability and the resilience of the grid. And even with things like storage, you can enable virtual transmission of electricity. There's a lot that can be done here. What's nice is that this is relatively low risk in the sense that if there is a big AI crash, well, total power demand, AI is still a pretty small part. So you're quite insulated from the crash. But the downside is you're not going to be making that much money. Just installing solar panels is not the most attractive business. So strategy two is we move a little closer, right, to the AI data centers. And how about we provide decarbonized power to those companies? And this is what a company like ExxonMobil is doing. They're building a 1.5 gigawatt natural gas turbine in Texas to supply clean electricity to data centers. And they're doing that, and they're making it clean with carbon capture. So we can invest in a company like Carbon Clear, which is really developing novel carbon capture sorbents for point source carbon capture, and we can provide electricity at a premium to these data center companies, right? And this is nice because, data center companies are willing to pay a bit of a premium for both reliable electricity as well as clean electricity. Companies like Google and Microsoft have these goals that they need to meet that they have set for clean electricity. So we can get a little bit more of a premium. It's a better business. It's a more lucrative business than just putting power on the grid. And again, data centers are not one-to-one with AI. So we're definitely at a little bit more risk to the crash. But there's still a lot of other data center uses that could really drive this. And if we want to get really integrated, we can go behind the meter with advanced technologies. And companies like Schneider Electric are already doing this. They have a microgrids unit where they're really deploying microgrid services to data centers, storage, on-site generation. And this is really helpful in areas where there's limitations on the grid, your ability to draw from the grid. And with technologies like geothermal, it's possible to generate electricity. I think Fervo has a partnership with Google to generate electricity. But also, you can theoretically use geothermal as a way of cooling, directly cooling some of those data center working fluids. So you're actually saving money because instead of needing HVAC to cool your working fluids, you can use geothermal wells. This is all great, really valuable business that can be built here, really, really high impact, really integrated. But the problem is that this is quite, risky. This is truly deeply integrated with the data centers. And if there's an issue or a delay in the data center construction or a problem with the data center economics, you could find yourself out of luck. And so we've got this strategy of trying to get value out of the growing demand for AI while avoiding the risk of the crash. And, it's okay, but there's a problem, which is that the more value we want to get, the more risk we're ultimately exposing ourselves to. But what if we changed our thinking, right? What if we said, instead of trying to avoid the crash, we get value out of the crash? And it's not as common, it's not as in the popular imagination, but at the same time as there was a dot-com bubble, there was also the telecoms bubble, the telecoms crash. And it followed a very similar trajectory, right? MCI merged with WorldCom in 1998. At the peak of the valuation in around 2000, it was worth $60 billion, this company. What they realized is that internet demand was not growing as fast as they thought. I think the projections for that was going to double 4 times every year, and in reality, it was doubling once a year. So when the bottom started falling out, they started doing a little fraud, which is not good. And then by 2002, they were bankrupt. By 2005, the rebranded MCI was acquired by Verizon for just $6 billion. And this acquisition was great for Verizon. This really formed the backbone of their 3G network that powered a lot of their revenue and growth through the 2000s. And I think there's an opportunity for energy companies to actually follow through on some sort of a similar strategy. As the data centers that are being built now are potentially going to end up underutilized or delayed, there's going to be an opportunity to buy up those assets on the cheap. If energy is really the differentiator for data centers, then there's an opportunity for data companies or energy companies to become asset owners in data centers. And if there's one thing that big energy companies are good at, it's owning and operating assets for the long term. I really don't think this is as maybe sort of egregious or sort of outlandish an idea as it first may seem. And I think that's especially true because I think we definitely will find something to do with the excess compute. If you look at the telecoms boom and crash, a huge amount of fiber optic cables and 3G networks were built out. And in the near term, there really wasn't a revenue stream from those. But in 2005, 2006, around the time that Verizon was buying MCI, people started inventing things to do with all that data center or all that data transmission capacity. Things like YouTube, right? All of a sudden, it was cheap and simple and convenient to upload videos and watch them online. And we got this new wave of social media apps and the modern internet as we really know it. And in a similar way, I think you're going to see something happen with data center capacity. We are undoubtedly going to put a huge amount of compute capacity into the market for very specific types of matrix multiplication. And that is going to drop the cost of doing that matrix multiplication down to rock bottom prices. It's a little hard to say exactly what we're going to do with it now. It could be AI. It could be large-scale simulations for fusion power or quantum chemistry calculations or something else entirely, right? A new application that we can't really envision right now. But something is going to emerge to absorb that capacity. And that means if you can get access to those data centers and hold them for long enough, I think that infrastructure will make money for you. So our second history lesson, the dot-com bubble, it paved the way for a new era of the internet. And I think the AI bubble is going to pave the way for the new AI-enabled future, maybe of the internet, maybe of something else entirely. Now, I've been talking a lot about AI. We're talking a lot about the bubble, talking about the relative near term, what's going to happen over the next couple of years. And I want to take a step back and get a little bit more philosophical. And I want to think about what is the impact of AI, not in the next 5 years, but really in the next 20 years or 50 years. How is it going to change our companies, our operations, the way we do business, everything? And to look that far forward, I think we have to look back. So I want to go all the way back to 1765. And in 1765, the Kingdom of Prussia had a problem. Their timber yields were falling. And what's worse than that, their timber yields were very inconsistent. Some years they would designate a swath of forest to cut down, they would cut it down, and there would not be very many useful trees in that forest because some of the trees are very good, they produce very high quality timber for shipbuilding, for construction, for other purposes, and many of the trees are only really good for firewood or for scrap. They don't produce the same quality of timber. And the Kingdom of Prussia had no maps. They had no way of really understanding which trees were in the forest. They could not see the trees in the forest. And so one guy came up with an idea. His name was Johann Beckmann. And Mr. Beckmann, his idea was nails and a little bit of paint on the end. What he did was he got a handful of attendants, a handful of assistants. He gave each of them a box of colored nails, and he trained them to identify a different type of tree. They picked a square kilometer of forest that they thought was representative of the broader forest, and they surveyed this forest. And when they did, when they would find a tree that they recognized, they would stick a nail into it, one of the specific colors. And at the end of the survey, they could tell exactly how many trees of each type were in the forest. All they had to do is look at those boxes of nails they had. They knew how many they started with. They knew how many they had at the end. All they had to do was subtract, and the difference told them exactly how many trees they had. And with this, the Prussian state could very successfully go out and identify the highest value forests to cut down. And when they went to replant those forests, they had a good system. They knew which trees were the most valuable, and they knew the density of trees that they needed. So when they replanted, they did so in straight lines. It was very easy. Just walk 10 paces, plant a tree, walk another 10 places, plant a tree. And with this, the surveying became even easier. You didn't need all the nails, all this other stuff. The tables that they had developed of numbers describing what was in the forest, well, the forest began to resemble those tables. And this worked. Their yields went through the roof. The map had reshaped the territory. The tool that they had used to describe the forest ultimately ended up shaping the forest as they recreated it in the image of the map. So everything's good, right? They got a bunch of wood, everything's great. There's a problem though. About 100 years later, what they realized is that this type of forest is actually very, very fragile. When they replanted the trees a second time, the timber yields fell dramatically because many of the trees died. And a new word was introduced in the German language for forest death. They had destroyed something when they reshaped the forest that they didn't even understand. And AI is a technology of seeing. Just like those nails and with little pieces of paint on the end, it allowed certain types of knowledge to become visible to an outside observer. For the Prussians, they could see the types of trees in the forest. AI allows us to look at written text, emails, PDFs, all sorts of posts on the internet. There's a huge amount of information that it can make visible to us. But there's a lot of information that is still invisible to AI. The emotions conjured by a piece of writing, the sentiment, the true sentiment, the person who is writing it. Knowledge that only exists in the heads of humans. So this knowledge has limits, and this AI has limits. And AI needs data to function. It has limitations in how it perceives the world based on the data it's trained with. Very famously, AI struggles to make the image of a clock with the hands pointing just at 12 because the training data often only really has images of clocks pointing with hands at 10 and 2. Newer models are getting better at this, by the way. But the point I'm making here is that the tree, the forest, and the company are pretty much the same. The use of technologies of seeing transformed the physical attributes of the forest, and so too the use of AI will transform the physical footprint and the operations of the company. Let me give you one quick example. If you use predictive maintenance in your business, some of your equipment will naturally be a better fit for predictive maintenance than other pieces of equipment. Maybe it has better data. Maybe the data is more deeply linked to the outcomes. Naturally, those pieces of equipment that have a better predictive maintenance outcome will last longer. And over 10, 20, 50 years, that is going to shape your asset mix. Now, at no point did you ever say, we want to own more of this type of asset than this other type of asset. But by deploying AI, by deploying predictive maintenance, you have shaped that asset mix unconsciously. And this is true across every application. If you use AI in hiring, you are selecting for, you are shaping certain attributes or personality traits or capabilities that look good to the AI. If you use it in promotion, you're shaping who gets promoted based on what looks good to the AI. You may think that you're just using it to help you make these decisions, but really, those decisions are being shaped by the AI. And this is important because when we use the Lux AI framework to determine what applications are going to come first or come more quickly, there's a very specific kind of application that rises to the top. Our framework has two parts. There's a value framework and a prioritization framework. In the value framework, we consider knowledge value and automation value, where knowledge value captures the impact that an application has on company performance, or key outcomes, and automation is really focused on the amount of labor savings. And there's actually a pretty detailed questionnaire that we've developed underneath this to help our clients assess the value created in each one of these applications. And you can see things like predictive maintenance here are quite valuable, right? They both save time and effort and labor, but they also improve the performance of the business overall. And things like internal knowledge management or sales documentation retrieval, these more sort of decision-making related types of applications are a little bit less valuable. But then we have the prioritization framework, right? Where we're really thinking about, all right, what's the time to value? How long will this take to capture value? And how long will this take to implement? And then what is the risk or the chance of success? And the better the chance of success is, the more it is on the right here. And you can see that these more managerial types of applications actually do better. Things like document retrieval, internal knowledge management, they're actually quite low risk. Whereas things like predictive maintenance, some of the pricing and forecasting stuff, they're actually a bit higher risk. And what that means is that AI is going to flow into these management and decision-making applications because it's relatively quick to implement, they're relatively cheap to do, and the risk of a failed AI deployment is actually pretty low. And so these decision-making types of AI, they're really going to become very common. And they're going to shape the type of people who work in an organization. They're going to shape the business decisions of the organization. And they're going to change the incentives of the employees. And I think the real risk here, the real challenge is that AI is going to transform companies without them even realizing it. They're going to make these changes to their business over the long term as they replace employees with AI and they augment decisions with AI. And they're not even going to realize that they're maybe losing skills or introducing brittleness into their company, just like the forest, until it's too late. So I want to just leave you with a few final takeaways. One, AI is coming. It will reshape practice, whether that's in business, whether that's in government. We're in a bubble, of course, but like the dot-com bubble, this is a technology that has true transformative potential. Two, you need to build a strategy that's resilient to data center overcapacity. You can sell picks and shovels, or you can try and be creative and find opportunities in asset ownership if you're willing to branch out of your established business model. And last, AI will transform your business. So it's really better to own the process. Companies are thinking a lot about the risks of failing to act with AI. But in my experience, not nearly enough are thinking about the risks of deploying AI successfully. And it's those risks that might really shape the future of the corporate world. So with that, I want to say thank you. And I think we have a little bit of time for questions.
Yes, thank you very much, Anthony. So we will now be taking questions you might have in the presentation. As a reminder, you can drop those into the questions box. And if we don't get to it on this call, someone from Lux will be in touch after the webinar as well. So I do see a couple questions coming in here. We received one early on around valuations for some of the large language model companies. Two really obvious ones. So why are they so high, and what is going to pop the bubble with some of those valuations?
Yeah, why are they so high is an interesting question. I mean, I think they're high because, I mean, there is a genuine transformative element to this technology. I also think they're so high because, you know, this technology is so expensive to develop that these companies need to tell a story that it matches the scale of capital that they need, right? So if you think about it, you know, these companies are saying, Sam Altman and like OpenAI have said, oh, you know, we don't even know what money will be worth in the future. Like, we don't even know what the economy will be like in the future. And you have to kind of give this very grandiose story when you're doing something so expensive, right? You can't just say, yeah, this is going to make emailing 5% more efficient, and we need to accomplish that $100 trillion or whatever. Like, that doesn't work. But I also think that you're sort of seeing a mismatch, right, in the business models themselves, right? Everyone is recognizing that the potential of the AI is really, really high, and that's why the valuations are so high. But in a lot of applications, like in the industrial world, it creates a huge amount of value, but companies like OpenAI aren't really in a position to capture that value. I mean, they mostly sell consumer subscriptions and you know, charge API access on a usage basis. And neither of one of those are really good for business applications where you're going to use AI just a little bit and potentially create a huge amount of value in an application like, I don't know, you know, predictive quality assurance, that type of thing. So to me, there just isn't like the correct business model yet for AI. And that's a big part of the reason why I'm skeptical that the current valuations are sustainable.
Yeah, that makes a lot of sense. And actually, one of the questions here was, are there other pathways to revenue generation for these companies? I think you kind of answered that. But is there anything you might add on top of your previous answer there?
Yeah, it's interesting. I mean, like, I think that the real question is, does AI become cheap enough that it becomes something that companies do in-house, right? You know, email is a really interesting example of this, where like no one makes money on email anymore, but obviously email is this like sort of fundamental, like it creates a huge amount of value, right? But like a lot of companies, you know, they maintain their own email servers. Google has Gmail, and there's these other email services. So people essentially give email away for free, right? And then they stack a bunch of other things on top of it, right? If you're a company, what you're probably paying for is like cybersecurity and hosting services and, you know, all the IT support when things go wrong, right? And I can kind of imagine a model like that where a lot of companies are maybe even, you know, they have their own models deployed on their own GPUs that are kept in-house. And what the ultimate business is really about is more about like AI cybersecurity. That could be a big business, or AI IT support. You know, that could be a big business, especially for smaller companies, even like Lux, right? Like we don't have our own IT department in our company. We have a third-party vendor that we go to, right? That is a model. If you really think AI is very transformative, but also can become very cheap and accessible to people, then looking at email is sort of my mental model for what the revenue operations could be.
Yeah, excellent. Makes a lot of sense. So that concludes our webinar for today. The slide presentation and recording from the webinar will be sent to all attendees via email later today. After leaving, you'll be prompted to complete a survey on today's presentation. We do appreciate any feedback you might have. It helps inform and helps us improve future webinars as well. So take a moment, check out our upcoming webinars here, and thanks for joining us. Have a great day.